Hi, this is Peter Schiff. It's Sunday, March 18th, 2012. There's been a lot of data points that have been released since the last video blog I recorded. I wanted to take some time and give you my reaction to what's actually going on, because a lot of people have now begun to talk about the U.S. recovery as if it's really firmly taken hold, that the much anticipated recovery is finally here, the stimulus is kicking in. Of course, all of this is complete fiction, but let me go over some of the data points that have sparked the optimism. I think it began last week, a week ago Friday, with the release of better than expected jobs numbers. Yes, we have been creating jobs, but the problem is the types of jobs we are creating are not the kinds that the economy needs. In fact, the jobs that we're creating are not making us richer, they're actually making us poorer. Nobody talked about this, but on the same day that we got the better than expected jobs data, we got worse than expected trade numbers. The deficit for January swelled to $52.4 billion. That was the highest monthly trade deficit, I believe, since July or August of 2008, just before the financial crisis. So if the jobs that we were adding were productive jobs, the trade deficit would be getting smaller. But it's not. It's getting bigger because we're creating more consumers, but not more producers. The people who are getting jobs in the service sector want to buy stuff, but since more Americans aren't making stuff, they simply spend their paychecks overseas and the trade deficit gets bigger. Now, people might say, but Peter, the trade deficit was getting bigger during the earlier part of the decade when the economy was growing. I would point out that no, the economy wasn't growing. We had a housing bubble. It was a bubble economy. Sure, people got jobs selling real estate, in mortgage finance, remodeling houses. A lot of people were buying things because of real estate wealth, and so we created jobs as we were spending the bubble wealth. But when the bubble bursts, the jobs disappeared. That's why unemployment spikes so much. We are repeating the same mistake. We are spending a tremendous amount of borrowed money, and as we spend that borrowed money, there are some jobs that are temporarily created as we spend ourselves deeper into debt. The problem is, when that stimulus wears off, when we can't borrow anymore, then the whole bubble implodes and we lose all the jobs. We don't want more bubble jobs that are temporary. We need real jobs that are permanent, jobs that produce more output so that we can decrease our trade deficit, so we can export more, so we can work our way out of debt. Even more important than the trade deficit, earlier last week, we got the fourth quarter revisions for our current account deficit, which surged by better than 15% to a new 3-year high. Now, the current account deficit also includes investment income. And here's the kicker. Right now, we have about a $50 billion positive in our investment income, even though foreigners own a lot more U.S. assets than Americans own foreign assets. The assets that foreigners own are a lot of treasuries. And the treasuries have a very, very low interest rate. And because the interest rates are so low, that helps keep the current account smaller. But as interest rates start to rise, that's going to increase the cost of paying interest on all the bonds that are held overseas. And that, together with a rising trade deficit, is going to make the current account deficit skyrocket. You can think of the trade deficit as kind of like a corporate profit and loss. When a country is making a profit, it's got a surplus. If it's got a loss, it's got a deficit. Well, we added all these jobs, but instead of getting bigger profits, the jobs produce bigger losses. This should give us a sign, indication that we are creating the wrong kinds of jobs, which of course we are. Yes, we created a few manufacturing jobs, but we need a lot more. And we don't need more of these service sector jobs in healthcare, in education, in retail, in finance. We have too many people devoting their energies towards those areas. We need more effort, more labor to be put to work in goods production. But of course, the jobs data was not the only data point that the markets, that the Obama administration seized on to try to claim that the U.S. economy is improving. Earlier in the week, we got the results of the stress tests. And of course, I'm putting the word stress in quotes because I don't believe that the stress tests were all that stressful, and I think that's deliberate. What the Federal Reserve wanted the banks to do was to run an analysis of how their balance sheets and how the banks in general would weather a storm that described by a big drop in housing prices or a big drop in stock prices. Well, that already happened. I mean, I hate to break it to the Fed, but the housing bubble already burst, and so did the stock market bubble. So seeing how the banks would survive a big drop in stock prices or real estate prices, to me, is making policy by looking in the rearview mirror. The last financial crisis in 2008, yes, we had a big drop in stocks, a big drop in real estate, but the next crisis is not going to look like that. In fact, the Fed assumes that the next financial crisis, if we have one, is going to be a carbon copy of the one we just had. Well, normally, when you get blindsided by a crisis, it's the crises you don't expect that hurt you, not the ones that you're preparing for or bracing yourself for. And I thought it was very interesting that the one big drop or the one bubble bursting that the Fed did not ask the banks to stress test was the bond market. What about asking the banks to figure out what would happen if bond prices plunged and interest rates soared? And of course, if that happened, yes, stock prices would also go down, real estate prices would also go down, unemployment would also go down, but a big collapse in assets in the economy with a rising interest rate environment is a lot different than a falling interest rate environment, which is what we had in 2008. Now, I think the real reason that the Fed did not ask the banks to stress test that was because they knew they would fail. There is no way these banks would survive a big spike in interest rates and a weakness in the economy and other asset prices. Now, you might say, well, the Fed probably didn't test that because it thinks it's impossible. The Fed thinks there's no way that interest rates could ever rise. After all, the Fed would have to raise them. Well, I'm pretty sure that had I come to the Fed or somebody come to the Fed in 2005 and said to the Fed, we need to do a stress test on the banks to see how the banks would survive a 30% drop in real estate prices or a 50% drop in stock prices or 10% unemployment, the Fed would have said, well, that's impossible. That's never going to happen. You might as well ask us to stress test the banks, for a massive, massive meteorite landing in Manhattan. They didn't think it was going to happen. Well, higher interest rates are not only possible, they are extremely probable. In fact, if you look at what's actually going on in the market right now, we have had a very big backup in interest rates in the last week. If you look at the yield of the 10-year, they've soared maybe 35, 40 basis points in a week, which is a huge move. It's interesting that we haven't seen a similar move in the mortgage market. My guess is that the reason for that is a lot of buying of mortgages on the part of the Federal Reserve. The Federal Reserve knows that higher interest rates will destroy the economy. It will burst this bubble that it's been desperately trying to reflate. That is the real reason that the Fed has got interest rates at zero. And in fact, if you look at the stress tests, under all the stress tests, the banks assumed that the long-term Treasury yield, the 10-year yield, stays no more than, I think, 1.8%. It's already well north of that now. And they assume that the Fed funds rate is still at zero. Well, what if it's not at zero? What if it's at 5%? What if the 10-year is at 7% and not 1.8%? Let's put that into the stress tests and see how the banks survive, see how the economy survives. That's the type of stress that we need to be looking for, but the Fed is not looking at those type of numbers at all. Also last week, we got the release of the Fed minutes, and that also created some optimism on the part of the markets that the economy was improving. The reason, well, the Fed in its statement didn't mention anything about QE3. And if the economy doesn't need QE3, then everything must be getting better. Well, the truth is, if the economy really were recovering along the lines that the Fed suggests, they wouldn't have extended their commitment to keep interest rates at zero through late 2014. If the economy were improving, why would the Fed have to keep it on life support? Again, the reason is the Fed knows the economy is not improving. It knows it's a phony recovery that's contingent on low interest rates, and that's why it is keeping them there. But it's not going to be able to keep them there. You can already see, and as I mentioned earlier, bond prices are rising, and they're rising rapidly. And they're going to continue to rise until the Fed buys treasuries by printing more money. And that is QE. They're already doing this in Operation Twist, but I don't know how much more Twist is going to be able to keep the lid on long-term interest rates. They're going to have to come out and more aggressively print money to buy bonds, and that, of course, is QE3. Whether the Fed wants to acknowledge it or not, they're going to have to do it if they want to keep interest rates from rising. If they don't do it, interest rates are going to rise, and then this whole phony economy or this whole phony recovery is going to come toppling down. I guess the last piece of good news supposedly we got last week was the CPI. Now, good news if you look at the core. It's bad news if you look at actual prices. The core was up 0.1%. And that led everybody to say, great news. See, there's still no inflation. Well, if you don't eat, if you don't drive your car, or if you believe the government, but even the government's numbers, the headline number was up 0.4%, which would annualize out to an annual rate of 5%, over 5% inflation. I think the true rate of inflation is more double that 5% level, closer to 10%. Whenever I talk about this, that the numbers understate inflation, immediately people start talking conspiracy to try to discredit me. It's not a conspiracy. It's deliberately designed this way. If you remember, or even if you don't, back in the 1990s, the Baskin Commission, Boskin rather, they came out and said that the CPI was no good because it overstated inflation. They said the CPI produced a number that was too high, and so they redesigned it to fix it. Their goal was to get the CPI to show a lower number than what it has shown in the past. So this is by design, and they exceeded maybe beyond their wildest dreams. I don't believe the CPI ever overstated inflation, but if it did, today it's at the opposite extreme. It clearly understates inflation. The problem is the Fed has a blind eye to real inflation, and all it does is look at these numbers, and it ignores what's happening in the real world. Look at the price of things. They're going through the roof, particularly oil. Oil closed up on Friday, another $2 a barrel. We're above 107 a barrel. Pump prices are now again at new seasonally adjusted highs. They're headed higher. What did we get this week? Obama came out and said the U.S. and the U.K. are going to collectively release oil from the strategic petroleum reserves to try to get the price down. It's not about supply. The reason we have strategic reserves is to help our economy weather a reduction in supply of oil that might be the result of an embargo or a war. That's not happening. Oil is flowing. There is plenty of oil. In fact, in the U.S., oil production is the highest it's been since, I think, 1993, and oil consumption is the lowest it's been since 1997. And why are Americans consuming, such a small amount of gasoline? Well, because so many are unemployed. If you don't have to drive back and forth to work, then you don't need as much gasoline. So supply is not the problem. At least supply of oil is not the problem. The problem is the supply of money. That's what's driving the price of oil higher. It doesn't matter how much oil we want to dump out of the petroleum reserve. If we keep printing money, the price is going to go up. Then the problem is, if we exhaust our strategic reserves, what do we do if we actually have a supply shock? These reserves are not there so that the president can try to increase his popularity in an election year. They're there for a real emergency. This is not an emergency. Oil prices are rising not because of Obama's energy policy, but because of his fiscal policy and because of the Fed's monetary policy in response to that fiscal policy. So this train wreck is coming. Meanwhile, The markets responded favorably. The Dow rose to new highs. The Nasdaq rose. The dollar rallied, although the dollar surrendered a good chunk of those gains later in the week. Gold also sold off on the optimism about the U.S. economy. If people are more optimistic about our economy, they don't need to hedge themselves with gold. So gold went down, although gold recouped some of those losses later in the week. Not so for the mining stocks. The gold mining stocks finished right on their lows. In fact, the gold stocks are at the same level they were when the price of gold was barely over $1,000 an ounce. You've got, what, a 60% increase in the price of gold or something like that, or a 50% increase, and the gold stocks are basically unchanged. To me, that shows a tremendous amount of pessimism, skepticism with respect to investors on the gold rally that's been in a bull market for over 10 years. It is really climbing a wall of worry, and I think the gold stocks reflect that. I think before too long, people are going to start to appreciate that this is a phony recovery, that the rally in the stock market is simply a reflection of inflation, not economic growth. And as bond prices begin to move down, the Fed is going to be under increased pressure to announce QE3. And when it does, that will be music to the ears of the gold traders. Meantime, I wouldn't be waiting for that. I think that the dip is already a big enough one to buy. And I mentioned this earlier in the video blog, but think about this when it comes to the trade deficit and the current account deficit. We've got this record trade deficit right now with better than 8% unemployment. Back in 2008, before the financial crisis, unemployment was in the fives. And we had a trade deficit this high. Can you imagine how big the trade deficit would actually get if we kept adding the types of jobs we're adding now and we actually brought our economy back down to an under 6% rate of unemployment? Can you imagine the enormity of the trade deficit? Also, as interest rates start to rise and our current account, our investment surplus turns into a deficit, I mean, this thing would just be spinning out of control. I mean, if you remember back in the 1980s, we used to talk about the twin deficits. Everybody talked about the twin deficits. What were the twins? It was the budget deficit and the trade deficit. And this is the late 80s, early 90s. Well, the twins are still there. They're bigger than ever. I mean, they're enormous. Yet no one talks about the twins. No one talks about the trade deficit. I suppose because it's gotten so enormous, no one even cares about it because we haven't had a disaster that we were worried about back in the late 80s when the trade deficit was a fraction of the size it is today. Well, the same attitude maybe is beginning with the budget deficit. Who cares about those? Those don't matter either. We'll just keep doing stimulus. After all, we got a printing press. Well, these twin deficits are going to kill us. They're going to kill this phony recovery and this phony rally in the stock market. Although I don't believe that the stock market is on the verge of a collapse like the Fed asked the banks to stress test, nor do I believe the real estate market is on the verge of another collapse. I believe the Fed will print too much money to keep that from happening. But the market that is on the verge of collapse is the bond market and the dollar, and in order to prevent that from happening, the Fed is going to print a lot of money, and that will put a floor beneath asset prices, but it will basically put a rocket ship beneath gold prices, and it will sink the dollar. And so I think that the reactions that we've seen this week in the Forex market and the precious metals market have gotten it wrong. And I also think, as I said earlier, the spin is wrong. The data points that we've been getting do not point to an improving U.S. economy. We are not resolving any of the imbalances that underlie our economy. The structural imbalances that led to the housing bubble, that led to the financial crisis, are being exacerbated, not alleviated. Everything the Fed has done, everything the government has done, is making our economy worse, not better, and the data points show that. Again, sure, temporarily, when you're inflating a bubble, you can create some phony jobs, you can create some excess consumer spending and government spending, you can create the appearance of prosperity. But all you have to do is look beneath the surface, and you can see that the real economy is not prosperous, it is in decay, it is deteriorating, and we are setting ourselves up for the next big crisis, and that's the crisis that the Fed is not even concerned about, it's not even worried about, nobody is talking about it, but we're talking about it here. Again, don't forget, I'm going to keep updating everybody on the situation more frequently than these video blogs in my radio broadcast at schiffradio.com. I do that show weekdays from 10 a.m. to noon on schiffradio.com, so don't forget to tune in Again, this has been Peter Schiff. Take care, everybody. And don't forget, like the video if you want. That way we get more people viewing it. Take care.